Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Theoretical view of the FX markets, currencies are a means of payment and create a relative price of equal goods in two economies. The exchange rate becomes a factor in global competition. A strong increase in a country's currency basically translates into cost disadvantage, though. That's the problem, is that as you do a more effective business, more efficient business, your currency usually gains in value, which actually creates a cost disadvantage that you somehow have to make up for with more efficiency gains. Nobel laureate in economics Milton Friedman, 1976, once said that a central bank can control its exchange rate, its interest rates, its money supply, but it can't control all three at the same time. In fact, we've seen in the last couple of weeks governments sort of trying to come up with this idea of what should they be looking at. Should they be looking at their interest rates, their exchange rate, and the money supply? They can look at two, but they really can't focus on all three, because one is going to really, all three of those, two are going to be somewhat, you're able to work with them, but the other will throw the other or the third factor out of whack. So another simpler view, risk is not binary, as some investors may believe. There's risk in almost everything. The difficult part is ascertaining an exact quantifiable amount, which of course is almost impossible, but mathematical models try to actually do that. So here's a recent chart, and if you look at the top pane, you're going to look at the CDD. These are not multiplied by 100, but of course we're trading the exchange rate multiplied by 100. And 5 of our 6, the only one we don't multiply by 100 is the yen. If you look at dollar, Canadian dollar, seeing in the top pane is obviously a bull trend. So the dollar is strong. This is counterintuitive, really. The idea that the dollar is rallying in face of such horrible news. Well, why? Many are saying because it's really the last safe haven, as far as it's such a big country, and it still holds this ability to preserve capital, and in times of trouble, many investors flee to the U.S. dollar. So you see that last year, when the economies around the world were actually strengthening, the U.S. dollar, if you look at the bottom pane, you'll see quite a weakness, because again, this is the U.S. dollar's view against the Canadian. So the U.S. dollar was sinking, and then in late October we had, for those of you that look at candlesticks or believe in that, you had a major hammer there, and that was a major bullish sign. Of course, you never really know until you see this in retrospect, but I guess that it depends on how you view the markets. Market bottomed out last October around 91 cents, and now it's trading around almost near 120. Dollar Swiss franc, seeing the same sort of thing. Last year, dollar very, very weak against the Swiss franc, trying to claw its way back. If you look at the bottom pane, trying to gain back most of what it lost in the last couple of years. Symbol there is SFC. Dollar yen, though, you're seeing something much different. Why? When you think about correlations, you're looking at the dollar yen being sort of the currency that the U.S. The yen is now the currency that has a status that the U.S. dollar used to have as the ultimate safe haven status for currency. So when the markets around the world are going berserk, most people are actually buying Japanese yen, again, because their economy is growing very slowly, but they've done a reasonably good job after their major recession in the 90s, recapitalizing their economy and not taking as much risk as some of the other economies. So at least that's the view of the markets today. So you see that the U.S. dollar is obviously looking, it's in a bear trend against the Japanese yen over not only the short term, but even the intermediate term there. And these are from Google Finance, where I looked at the dollar against the euro. And if we look out a couple of years, again, this is a little bit longer term time horizon, you see that the dollar had a nice run recently relative to where it came from in 2005. That rally is really nothing. The dollar, and this is probably one of the reasons that so many people, so many institutions were short U.S. dollar down from a top of 85 in 2005 all the way down to about 61 cents. And then it rallied from 61 right to about 71, 72, actually 74, where it closed on Friday. So that chart is actually cutting off a couple of days because the last price is about 74 cents. Take a look at the dollar against the British pound. We've gained back most of what the dollar lost as we're trading almost up at that 57 cents. Dollar Aussie, well, this is really interesting. I'd urge all of you to do more research on this because I find it's hard to believe that the dollar would go from such a level of U.S. dollar being so weak. The dollar is so weak from 2005, 2006, 2007, and then all of a sudden, almost one day, everyone just changed their mind and said, you know what, I prefer U.S. dollars. I no longer want Australian dollars. So the U.S. dollar went from around 102 to $1.50. I guess it closed at 144 on Friday. This, to me, is the most amazing move. We had about a 50% move in the U.S. dollar Australian rate in just a couple of months. So this is amazing. And again, if you have a view on this pair, you can trade options right through your equity options broker. So this is the SPY chart as of a couple months ago. And I gave this presentation a couple months ago for another broker. What I said was recently the Canadian dollar, yen, British pound, Australian dollar, Swiss franc have all started to outperform the stock market. Now, of course, the yuck is outperforming, but it obviously is dropping. So it's just not moving down as quickly. And interestingly enough, I didn't include the euro because the dollar against the euro was strong at that point. But obviously the euro has succumbed and the U.S. dollar has rallied against that one also. So look at this chart. My gosh. The dollar, I'm sorry, this is the U.S. stock market. So the top pain, and this is pain, if any of us that are long the U.S. stock market, a different kind of pain, the U.S. stock market in that top window, you'll see that it just broke down late in the summer. And if you look at the weekly chart, it even gives you a better view of it. Really what is happening is that sort of in August, the market started breaking down. And once it broke that 120 level, it was just a waterfall decline from 120 down to about 90. So just a quick drop. So, stock investments in general lost about 25% in a month, which is really unprecedented. So just remember, with options, you have the ability to have limited risk. You can target your short or intermediate term goals. Versatile tools, the options are versatile tools that allow investors to make their own risk-reward choices. Investors can choose from a variety of objectives. They can hedge. You can implement price forecasts. You can increase your portfolio returns by selling options. You can create unique payoffs by using spread strategies. Managing positions, well, financial success is going to depend on, again, how well you manage both winners and losers. If your portfolio has many positions that are all expected to move in the same direction at the same time, that's good if you know that for sure. But again, many of us, we don't know that for certain. So that's why I just want you to be aware, this idea of diversification, the idea of trying to find assets that aren't so correlated to your overall portfolio. At least that may be another way to look at it. 2008 has been a very challenging year for the overall market, specifically for the financial sector. Individual equities can do much, can actually move much further up, down. So, when we talk about reversion to the mean, you have some actually never return. WorldCom, Enron, internet stocks, individual stocks. Even some sectors may not revert back to the mean. Individual equities tend to have much higher volatility than ETFs. Groups of stocks tend to balance themselves out as opposed to individual stocks. This is known as the concept of correlation. So foreign currencies have traditionally shown low correlations to equities and bonds. Considering the versatility that the listed options market provides, investors may want to consider some of your favorite option strategies using the ICFX options to reduce your correlation risk. So again, correlation, trying to basically diversify, that's the idea behind it. different asset classes and specific assets, trying to hopefully manage so that not all of your assets are moving in one direction at the same time without an extensive amount of mathematics. One definition is the strength of a linear relationship between two variables. So a more practical view is how one asset moves in relationship to another. For correlation to exist, the relationship must be somewhat linear, or variable must have some effect on another.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.